There is a rare subset of traders operating far outside the glass towers of Wall Street. Working entirely alone from quiet home offices, they extract millions of dollars from the markets, consistently outperforming billion-dollar hedge funds equipped with armies of analysts. The natural assumption is that these individuals possess some hidden advantage, a proprietary algorithm, a faster data feed, or simply a rare, innate talent for predicting where the economy is headed next. Peter Brandt and Jason Shapiro are two of these highly successful solitary traders. But if you look at their early careers, you quickly realize they don't have a crystal ball. In fact, their initial attempts to forecast the market ended in complete financial disaster. In the 1970s, Brandt started his career in the physical trading pits of the Chicago Board of Trade. He listened to the firm's analysts over the speaker system, absorbed their fundamental crop reports, and bought into their sure-thing grain forecasts. He confidently placed his trades and proceeded to blow out his entire account balance 3 or 4 separate times. Human psychology craves certainty. We desperately want to know what happens tomorrow. But in financial markets, relying on the illusion that you can predict the future is a mathematical guarantee of failure. Jason Shapiro learned this same lesson in the early 1990s. Living in Hong Kong, he started buying Hang Seng futures during a runaway bull market. Because prices only went up, he quickly turned a $100,000 stake into $700,000. He bought a Porsche and convinced himself he was a financial genius. Then the bull market ended. The trend reversed, but Shapiro's ego refused to adapt. He held on to his positions, convinced the market would eventually validate his brilliance. Within 6 months, the entire $700,000 was gone. Years later, trading from a beach house in Thailand, he made the opposite mistake. As the late 90s tech bubble inflated, Shapiro desperately wanted to be the lone hero who correctly called the top. He continually shorted the U.S. stock market as it climbed higher and higher, wiping out another $500,000 account in the process. Our brains are hardwired for financial self-destruction. Pride drives us to fight powerful trends to prove we are smarter than everyone else, or fear drives us to blindly follow the herd. Surviving the market requires completely overriding your own natural instincts. After his early failures, Peter Brandt realized he was his own worst enemy. To actually make money, he had to entirely abandon the idea of forecasting where prices would go. This animated chart shows how Brandt currently utilizes horizontal support lines. He doesn't look at these patterns to predict the future. He uses them strictly to locate setups with asymmetric risk, situations where the mathematical potential for profit is massive, but the point of failure is immediately defined and close by. Whenever Brandt enters a trade, he limits his maximum possible loss to just 0.5% of his total equity. He places his orders operating under the strict assumption that every single entry will be a loser. He also enforces a rigid Friday rule. If a trade shows a net loss by the Friday close, he liquidates the position entirely before the weekend. He removes the asset, and with it, he removes the dangerous human emotion of hope. To prevent impulsive midday reactions to flashing red and green numbers, Brandt does his chart analysis when the markets are closed. During trading hours, he acts as a glorified order enterer, executing the exact plan he wrote down over the weekend. Brandt doesn't make a living because he is right about the market. He makes a living because his mechanical rules mathematically lock his ego out of the execution process. Jason Shapiro developed a different mechanical system. He realized that whenever the overwhelming consensus of the crowd agrees on a trade, it is almost always a trap waiting to be sprung. The perfect illustration of this danger is the 1998 collapse of long-term capital management. The smartest hedge funds on Wall Street all crowded into the exact same European interest rate convergence trade. The math was flawless, the logic was sound. Then Russia defaulted on its sovereign bonds. Facing massive margin calls, funds were forced to liquidate assets quickly. They all tried to sell their European convergence positions at the exact same moment, only to discover a completely empty room. There were no buyers left because everyone who wanted the trade already had it. The crowded trade collapsed. This diagram visualizes the Commitment of Traders report, a weekly government data release that Shapiro uses to track the crowd. It divides market participants into two camps: the speculators, representing the momentum-chasing herd, and the commercials, who are the actual industry insiders using the physical commodities. Shapiro doesn't guess when a trend will end. He watches the data and waits patiently for the exact mathematical extreme, the moment when the speculators are totally maxed out on one side of a market, before he places his contrarian bet in the opposite direction. By outsourcing his contrarian instincts to hard data, Shapiro exploits the emotional extremes of the herd without getting caught up in their noise. Brandt uses short-term chart patterns to minimize risk. Shapiro uses government data to fade the consensus. Their methodologies look completely different on the surface, but their underlying philosophy is identical: pure anti-instinct. Brandt operates by a strict motto: strong opinions, weakly held. You must fiercely commit to your setup to enter the market, but the second the price action moves against your thesis, you drop the trade immediately. Operating this way requires massive psychological endurance. Elite traders are wrong constantly. The vast majority of their trades are throwaways that yield tiny losses. They have trained themselves to take absolutely no personal offense to a losing trade. Amateur traders almost always hold on to their losing positions because taking the loss requires them to admit they made a mistake. They crave emotional validation. Professionals survive by coldly accepting probability and risk management. The financial market isn't a math puzzle to be solved. It is a mirror reflecting raw human emotion. The only way to consistently extract money from it is to systematically remove your own humanity from the equation.